Welcome to Personal Finance for Long-Term Investors, where we believe Benjamin Franklin's advice that an investment in knowledge pays the best interest, both in finances and in your life. Every episode teaches you personal finance and long-term investing in simple terms. Now, here's your host, Jesse Kramer.
Hello and welcome to Personal Finance for Long-Term Investors. My name is Jesse Kramer. This is a bonus episode. We might not give it a number. If we do give it a number, it'll be 105. But I think there's a way we can release it as a bonus episode. I'm recording this on April 10th, 2025. We're going to try to get it out to you by April 14th, 2025. And in case you can't keep track in your own head, because who can, we're recording this on Thursday. This is one of those days where the market was down. Yesterday, Wednesday, the market was up 9%. Today, the market's down 3.4%. We're recording this, of course, to talk about tariffs and some tariff-related things. And I know you might be tariffed out at this point, but I'm still getting a good amount of questions, and I've written a bunch of blog posts in the last few days, and I figured for those who don't read the blog but do listen to the podcast, you might want some content too. So just for a quick recap of kind of where we are as far as what's gone on, the tariff news hit last Thursday and Friday, and we had these back-to-back 4 or 5% down days. The bad news continued into Monday this week, kind of leveled out on Tuesday. Wednesday was the day where President Trump announced that the tariffs were off. It's kind of like the snip, snap reference in from The Office, if you know what I'm saying. And then today, Thursday, the market slid another 3 or 4%. So we're off. I'm looking at the S&P 500. Right now, we're off 14% from the highs back in February. And we're down about 7% from where we were before April 2nd, right? April 2nd was, what was it called? Liberation Day? Is that what President Trump called it, I think? So whatever we want to call that day, we're down about 7%. What I want to do today is take some of the articles that I've written in the past few days and explain them, or kind of maybe add some voice to them and share them with you listening on the podcast, because I think that'd be helpful. And then I have some other thoughts to share too, inspired by Doc G over at the Earn and Invest podcast. He put out something pretty cool that we'll share in the show notes. And I want to expand on some of his thoughts. Pretty ironic, pretty coincidental. My family and I, we flew to Florida for a mostly fun but semi-work related trip on Saturday. So again, the markets were down Thursday and Friday, not great. Going into the weekend, we flew down there, and I spent too much time, more time than I wanted to over the weekend and into this early week. When I should have been vacationing, I spent some time talking to clients and writing on the blog, writing to you all, which is fun. I mean, right? I think it's really fun. It's that classic strain that we feel, I suppose, between resting and relaxing and spending time with our family, which we all need to do with making sure we do our work obligations. It's just, hey, if I have a client who's really worried or a client who's panicking, it's a big, important obligation that I make sure that they feel heard and make sure that they understand why that's probably not a good thing to do. And I just really like the writing portion. So I wrote a bunch in the last few days, and I'm going to start with the 15 tariff questions I've heard the most, because my blog inbox, my professional inbox, they did explode late last week and over the weekend with tariff questions. And at first I thought, well, everybody's already talking about it. Do I really need to add my voice into the fray? But the questions kept on coming. And, again, April 3rd, April 4th last week were terrible. The futures market looked really glum as soon as it opened up on Sunday night heading into Monday. At that point, I think heading into Monday, we were down something like 10% since April 2nd. So I wrote up a Q&A. My goal is to make it rapid fire, easy to consume. And if you're sick of tariff talk, feel free to skip this entire episode. And if you know everything already, feel free to skip it. But if you want some simple yet thorough breakdowns, then let's chat. So what's a tariff? Tariff is a tax that a government, like the USA in this case, charges on a foreign import. The tax is typically a percentage of the price that the domestic buyer would pay to the foreign seller. Why are we enacting tariffs? Well, the glass half full rationale is mainly to protect domestic industries against cheap foreign labor and as leverage against foreign economies. Hey, our tariffs will make your lives harder, so come to our table and negotiate. But more likely than not, the self-inflicted pain of tariffs far, far outweighs the benefits of tariffs. Now, a really good question. Okay, those are some basic questions. We're now getting into some of the interesting questions. Who actually pays for the tariff? The answer is just about everyone. On their face alone, we already said the importer is the one who pays the tariff to the government. But the importer, that importing business, they don't want to stomach the entire bill of the tariff. They're going to pass on the cost of the tariff perhaps to the foreign exporter, definitely to the eventual buyer, that'd be us, consumers, So the short answer is we all pay for tariffs. The next question I've been getting, so tariffs are bad then, right? Well, regardless of economic or political loyalty, most economists agree that tariffs are more bad than good. Many are saying they're far more bad than good. They cause inflation, they slow down economies, and that duo of effects is called stagflation, and that's very bad. Why did the markets drop over the last week? Well, market prices are all about expectations, right? What do we think will happen? And what would the appropriate stock price be if that were the case? President Trump's tariff announcement and the subsequent 14% and counting sell-off as of when I wrote this article made two things clear. Well, the first is that many investors were uncertain whether President Trump would follow through with his threat of tariffs. And then the second thing was that if he did follow through with tariffs, many investors underestimated the magnitude of those tariffs. The announcement, and now the unannouncement, mainly the first announcement, was significantly worse than expectations, hence a rapid and significant price correction. How can everything be down and how can nobody benefit from these tariffs? Again, US stocks were down 10%. International stocks were down 6%. Bonds have been roughly flat. Real estate is down. Gold is down. Other commodities are down. How can everything be down? Surely someone in the economy must be winning. Well, the answer is that tariffs are a tax that everyone pays for in some form or another. The extra costs are felt in all corners of the economy. The only winner in terms of dollars and cents would be the government who's collecting the tariff. And governments collecting more revenue is not necessarily stimulative of the economy. The next question, why is this time different? The famous saying in investing is, the four most dangerous words in investing are, this time is different. And in some ways, this is not different. I've written many posts about market history, including the frequency of choppy markets. But in one major way, yes, it feels different. This feels self-inflicted. Sports fans, for example, we expect that our team could lose. We know it's a possibility. It's the nature of the game. But what we don't expect is for our own player to turn around, to run the wrong way down the court and slam dunk on his own basket to lose us the game. That's not the kind of loss we expect. And this tariff tantrum sell-off, it feels like that. As other commentators have written, he pressed the red button or he shot the hostage. Everyone agreed how bad it would be if we pressed that button or shot that hostage or dunked on our own basket. And yet here we are anyway. And that aspect of what's going on right now certainly feels different. The next question I've been getting is, well, Jesse, but markets always come back, right? And so far in history, yes, they do. Eventually, yes, they do. But I don't think that's a reason to feel good necessarily about current market conditions. And we will come back and tackle this topic later. The next question, they say that you can't beat the market. How was the market so wrong by 10% over 2 days? Like, how has the market changed so much over the past week if you can't beat the market or if the market is always right? And the answer there is that market values are a representation of the average investor's opinion on appropriate pricing, understanding all the current facts. And this sell-off proves, again, like we already said, that the average investor was either unsure if Trump would follow through on the tariff threats and or was optimistic about the magnitude of what the tariffs would look like. As soon as those expectations got reworked based on the new reality, we saw stock prices change very, very quickly. The next question, should I sell off all of my US stocks or all of my international stocks or all stocks altogether? I pound the table here on the podcast and I pound the table on the blog that stocks are a long-term investment and for most of us a 10 plus year investment. And so I went back, I printed out a really cool chart. We'll show it in the show notes. It shows VT, Vanguard's total world stock ETF. It shows 10 years of data. It's inflation adjusted, meaning it shows a true increase in purchasing power, a real return. It includes dividends being reinvested, and it also includes the past week of market turmoil. And even including this recent week, and despite the constant drag of inflation, an investor's real inflation-adjusted returns over the past decade have been 6.2% per year. Or if we were to remove inflation and measure in nominal terms, it would be 9.8% per year. The point being, when judged on a 10-year timeline that I think about, stocks have been a wonderful investment for the past decade. Is that guaranteed to continue for the future? Absolutely not. I certainly don't know. Nobody knows, but I am betting on it. The next question, are you rebalancing? It might sound crazy, but yes, I am still using my personal predetermined rebalancing rules. I am not selling stocks. In fact, I've been buying stocks. It's not easy to do. I take some cognitive, I don't know how to describe it, I suppose, some cognitive guts to do it, right? To watch your portfolio drop by 5 or 6 figures or 7 figures, depending on how much wealth you have out there listening, to watch your portfolio drop, to see that stocks are the reason why, and then to buy more stocks anyway, to rebalance. It's certainly not easy, but it is the proper way to go about portfolio management. Personally, I rebalance both on a calendar basis and on thresholds, meaning I rebalance every 6 months simply to ensure that I won't go years without doing it. And then I also rebalance when my portfolio allocations go more than 5 percentage points off target. The next question I've been getting, will tariffs affect my monthly budget? Most likely they will. Tariffs are inflationary, as a portion of the tariff tax gets passed through to the final prices we all pay. There's one estimate from Yale University suggesting that the average U.S. household spending will go up about $3,800 a year. Now, this was based on the initial tariff announcement, which then President Trump rescinded, brought it back. As of now, as of this recording, there's a 10% tariff on every single country, except for China, which I believe has a 125% tariff on it. The government, the president, brought the tariffs back down to earth. They still exist, and I think we should still expect that our monthly budgets will go up. The next question, will the tariffs affect my job? Possibly. As businesses struggle to cope with increased costs, they're going to look to cut costs somewhere else, and labor costs are going to be one of those places. They will lay off their staff in some part if push comes to shove. So if you don't have a substantial emergency fund, I would consider building one right now. Another question I've been getting from listeners, will tariffs affect my business? And certainly the answer is yes. And it's for the same reasons listed above, is that your costs, whether it's the things you spend money on that are domestic or imported, it's all going to get affected. The economy is so interconnected that everything will feel some sort of tariff inflation, most likely. The last question I got is basically, how should I feel? Or how do you feel, Jesse? And again, the answer there is not great. I think the self-inflicted nature of this feels bad. But this is the magnitude of risk that I at least signed up for when investing in stocks in the first place. I actually take that back. I signed up for way more potential downside risk than this. I will shout from the rooftops that stocks can and likely will again, at some point in the future, go through a 50% drawdown or more. And that kind of drawdown can last for months or even a few years. And as of this recording, we are not there yet. We're not even close to being there yet. What's going on right now feels like a classic combination of one, that yes, something fundamentally bad is happening, and that should negatively affect stock prices, right? Fundamentals of how corporate profits will change in the future, that should affect stock prices, and that certainly is right now. But there's also the second thing that's going on right now, which is panic, or at least some sort of fear-induced selling. You've got this first-order fear that is pushing investors to sell, and then other people are seeing or feeling or predicting that fear, and they're trying to dump their stocks before it gets too bad. It's almost like second-order fear. Or others are trying to buy the dip, or others are trying to guess what's going to happen a week from now. And that's not fundamental. In many cases, or in most cases, what's going on right now, that's kind of panic selling. It's the opposite of the positive euphoria that creates bubbles. And so the lesson here is to not forget that Mr. Market, right? Benjamin Graham's famous parable, Mr. Market, is a manic depressive. During times of raging bull markets and bubbles, there's a mania, right? It's an illogical buying pressure. And sometimes in the panicky bear markets, there's an illogical selling pressure. There's the depressive side of the manic depressive. Mr. Market is a manic depressive, and that's actually a good transition into the second article I'll read right now, which is 15 questions for scared investors. It's actually funny. I pressed publish on this article on April 9th, about 45 minutes before President Trump announced the 90-day pause on tariff, sending the market rocketing. Right. I think the market increased something like 8% over the course of 90 minutes. It's just funny timing on that. But anyway, here's a list of punchy Socratic questions that I just want to float them out there and let them sit. And just like in the article itself that I wrote, I asked these questions. I didn't provide answers because my goal here is to ask these questions and get you to pause and think about your answers. In fact, after each question, I'll probably leave a second or two pause in case you want to actually pause the podcast episode and think about this question yourself. Because at the end of the day, I think your answers matter here. My answers might be fine, or best practice answers might be fine, but really your answers matter. And maybe it's a bit like therapy, where it's not really about me, it's about you, and it's important that you come to your own conclusions. So the first question, speaking of Mr. Market, is this question: is Mr. Market being manic or depressive right now? Question 2, did your goals change in the past week? Question 3, did your timelines change in the past week? Question 4, what does your financial plan require you to do right now? Question 5, if the stock market closed for the next 5 years, would you be comfortable with what you own today? Question 6, if the political party flipped, but the other facts stayed all the same, would you still feel the same way that you feel right now? Number 7, are your current decisions being driven by evidence and analysis? Question 8, what does long-term mean to you? Question 9, what will happen if you do nothing at all right now? Question 10, are you chasing certainty in an uncertain world? Question 11, is discomfort a reason to act or part of the ride you signed up for? Number 12, what are your expectations of a worst case scenario in your portfolio? And are we there yet? Question 13, if you sell now, what's your plan for buying back in? Question 14, have you rewritten your personal investment philosophy? And question 15, if you weren't already in the market, would you choose to invest today? So those were the 15 questions for investors who are feeling a little bit of anxiety right now. And I think thinking through your own answers might make you feel better or might lead you to make better decisions in your portfolio right now. The last article I wrote recently starts with this little parable about Marie Antoinette, the French queen. Historians doubt that Marie Antoinette ever said the famous phrase, "let them eat cake." The apocryphal tale is that upon hearing that French peasants had no bread, she ignorantly suggested that they eat brioche instead, which is richer and a more expensive pastry. Kind of shows how out of touch she was. But historians doubt that she ever said it. The quote likely originates decades earlier, used to criticize out-of-touch aristocrats. But still, the myth stuck, fueling this image of a clueless queen symbolizing indifference during the French Revolution. But fast forward to modern times, and I personally read account after account of panic selling over the past week. The tariff tantrum, the Trump slump, it instilled many investors with a deep level of fear. And for some, the fear is purely financial. Like, will my portfolio recover? Do I have enough time? Will I be able to retire on time? It's really a numbers-based financial fear. For others, it's a socio-political fear. Essentially, what will President Trump do next? And for many, it's a mix. Some people are abandoning their plans and abandoning their portfolios for a mix of the two reasons. Now, I don't like seeing this. I don't want anyone to make short-term emotional portfolio decisions. But there are billions of people out there, and at least many millions of them are market participants. And I can't change all their minds. None of us can. And unfortunately, some of those people, they need to make mistakes in order to then learn the lessons. And that's why, as uncallously as I can muster, I think to myself, well, let them trade stocks. Okay, why are people trading right now? Let's walk through the most frequent reasons I see people trading right now. The only good reason, as far as I'm concerned, there's only one of them, and that's to rebalance your portfolio. We already talked about it. I rebalance based on calendar and based on thresholds. There's no emotion in a rebalancing decision. It's purely rules-based, and you set the rules up front. You include them in some sort of financial plan or investor policy statement or whatever you want to do. And then when the rules kick in, they kick in, and you follow the rules. And if your personal rebalancing rules are kicking in right now, carry on. You could say that you might want to tax loss harvest or execute a Roth conversion right now as a function of falling stock prices. That said, neither one of those practices should involve selling one asset to buy a completely different one. Like, you shouldn't really be trading per se when you do tax loss harvesting or Roth conversions. Personally, though, as I write about in two links that we will share in the show notes, one about tax loss harvesting and one about Roth conversions, tax loss harvesting is not the miracle drug that many DIYers believe it is, or at least I certainly don't think so. And I think those who do think that tax loss harvesting is some kind of miracle drug, they don't really understand what tax loss harvesting is. They haven't actually gone through and done the math themselves. And then on the Roth conversion point, I don't think it makes sense to wait for bad markets to then execute Roth conversions. It really is a form of timing the market, in my opinion. So that's why if you are tax loss harvesting or doing Roth conversions right now, I'm not going to tell you not to. I mean, you're better off doing those things now than you were a month ago, that's for sure. But I do think moving forward, waiting for bad markets to do Roth conversions, it's like, what if the bad market doesn't come in a particular year and you're just missing out on a chance to do a Roth conversion? I think there's that. Or just what if the market runs away from you and you were just best off doing the Roth conversion in January? There's always that possibility. And then, tax loss harvesting, it's better to do it during times like this than it is to wait for the end of the year. I think a lot of people, they just kick it down the road to November or December. That's not smart. You should tax loss harvest. If you're going to do it, you should do it when there are losses. And right now is a very likely time when there might be losses in your portfolio. I just think it's not something that's so high on the priority list that you must do it every time the market changes. because the actual benefit of tax loss harvesting isn't huge. But anyway, that's the one thing that you should be doing right now is rebalancing for sure if your predetermined rules suggest that you do so. Some people are making changes right now, though, as we already talked about. They think it will get worse. They think that the portfolio, that their economy, the new trade war, the world is heading in the wrong direction. And the belief is that it'll get worse before it gets better, or even that it'll get worse indefinitely. Now, these people may be right, and I may be crazy, but I don't know if that's true. And I don't like what's being done. I don't agree with the decisions being made economically or the logic of the people who are making these decisions. But I do know for sure that if you know for sure that stocks are a poor investment going forward, then I don't know enough to determine if you are right or wrong. Maybe it'll get worse, maybe not. I don't know. That might have been poorly worded. It might be like Bilbo Baggins in The Hobbit or in Lord of the Rings saying, I don't know half of you half as well as I should like, and I like less than half of you half as well as you deserve. But basically what I'm saying is that you might be certain, I'm not certain, and I don't know how you could be certain. And some of you will hear those words and you're going to say, Jesse, of course things will get better. That's what humans do. We improve over time. And others of you, you're going to hear it and you're going to say, Jesse, the current events are pure insanity and we are irrational beasts and the world as we know it is crumbling and you're just being blind and obtuse. Maybe one of you is right. I don't know. Financial planning and portfolio design are exercises in probability and risk management. And if I knew where the world would be in 5 years, I would triple down on my specific bet and I would become a billionaire. And if you know where the world is going to be in 5 years, I encourage you to do the same thing. Go make your billions and don't forget about little old Jesse when you make it big. But if you're like me and you're unsure where the world is going, then I'd ask you this. How is that simple truth that you and I cannot predict the future? How is that simple truth any different than it was a month or a year or a decade ago? It's not any different. We've never known how the future would unfold. Never. I build financial plans for myself and others with that fact in mind. Good portfolio design accounts for the fact that the future is inherently unknowable. That is one of the risks that we take. It's the major reason why we investors demand compensation for investing. And since that fact hasn't changed, I'm not changing my portfolio allocation. Time will tell, right? You may be right. I might be crazy, but I'm not betting on it. Okay, other people are saying, well, future events aside, Jesse, or socio-political events aside, my plan, my portfolio can't handle this. These people are looking past the causal events. They're looking past the global, the political, the economic events, simply focusing on their own personal financial plan. And they are concerned that their portfolio dropped too far and too quickly over the past week, that the situation is untenable based on the sheer financial math of it. And they need to cut their losses from stocks right now and reallocate to a much more conservative portfolio. Now, the crazy thing is, some of those people are right. But if that's the case, then that truth for them, which is that they ought to be more conservative, that has been real for years. If it's true right now, it means it was also true before, and they should have reallocated their portfolio years ago. And now, faced with the downside of carrying so much risk, they see the downside in their portfolio value. It's dropping. And now they're realizing that they had too much risk in the first place. This is the driver who only after crashing their car is realizing that they've been a maniac on the road. The crash itself isn't the reason to change. The crash is just the proximate event. Now, risk tolerance, it seems quaint when the market is doing well, but sudden negative shocks like this one often make investors realize, oh, my risk tolerance isn't what I thought it was. This is where we insert that Mike Tyson quote about, everyone has a plan until you get punched in the face. These tariffs didn't change the truth. It just brought the truth to light. So some people have this fear and they're right about it. They should have been making these changes years ago. They should be more conservative than they are. And yeah, unfortunately now, they're going to most likely have to make a portfolio change even after suffering losses, which isn't great, but is probably the right thing to do. But another group of people out there, they share the same fear that their portfolio can't handle such losses or that their portfolio is misallocated, but they're simply mistaken. Despite their fear, what they ought to do is stand there and do nothing, as John Bogle would say. That said, I completely understand where this mistaken fear comes from. Take a 65-year-old retiree with $2 million and a 60-40 portfolio. Their portfolio has likely decreased $100,000 or $150,000 in the past week, maybe $250,000 over the past 6 weeks, because really we peaked in mid-February. Now, to see $2 million turn into $1.75 million over a couple months, that's the equivalent of watching multiple years of living expenses just kind of not disappear. I don't like when people say that, but The portfolio value is gone. It's scary stuff. I understand why that retiree might want to abandon ship. However, their 40% allocation in bonds has remained essentially stable, and that allocation ought to account for, say, 8 to 10 years of living expenses. The bonds are buying them time, literally, right? They must ask themselves, should I assume that my stock allocation can recover and then some over the next 8 to 10 years that my bonds are buying me? The answer is likely yes. It's not a guarantee, but then again, it never was in the first place. There's a third group of people who are saying incoming inflation, incoming recession, this industry is going to fail, that sector is going to fail. They're citing specific fundamental reasons for jumping ship. All of that fear, all of that probability is already priced into the market. Now, if the worst case comes to pass, then the stock market will surely get worse before it gets better. But if President Trump and or other world leaders deviate over the next few weeks or months, then perhaps none of those fears will come to pass. The market is trying to suss that out, and it's changing not by the day, not by the hour, but by the minute. And that's a really important thing to realize. That's the reason why the biggest up days in the market occur concurrently with the biggest down days. All of that uncertainty shakes out in both directions. We suddenly realize, or the market suddenly realizes, that it's been more optimistic or more pessimistic than it should have been. The point is, whenever the market turns around, it's likely to be sudden and sharp. If your money is on the sidelines, you won't have time to get back in. Now, again, I'm not saying I told you so here, listeners, but I wrote this article on April 8th, which was Tuesday. Tuesday, I think, was the relatively flat day last week. I wrote that on Tuesday, and then on Wednesday, the market was up 9%. It's not a good thing, by the way. To have the market go up 9% isn't a good thing. It's a crazy amount of volatility. They call it volatility clustering in some cases, where the biggest up days and the biggest down days happen near each other. And if you let the biggest down days scare you out of the market, then your money's going to be on the sidelines. You won't have time to get back in during the sudden and sharp increases. The same exact phenomenon happened in 2023. It was amazing to watch unfold, November of 2023. I wrote an article about it. We'll link it in the show notes. It's called Last Week's Terrific Real Life Stock Lesson. That same thing's going to happen again. I don't know when, and neither do you, but it will happen again. The last reason that I wrote why people are trading right now is to buy the dip. We are going to talk about buying the dip in a minute. Buying the dip is not smart. We'll come back to that. But the whole idea of this article was that you can lead a horse to water, but you can't make them drink. There are many reasons why people are trading in their portfolios right now. Most of those reasons aren't good. Unfortunately, history would tell us that many people learn painful lessons this way. Perhaps it's the only route to learning those lessons. I'm just not sure. So I say, let them trade stocks. The only thing that you and I can do is to control our own investing choices, to share good evidence about the right and wrong investing choices, to do our best to understand others' reasonings, and if they'll listen, to share our own. It's not really fun out there right now, but this is part of the investing process. Here's a quick ad, and then we'll get back to the show. Every week, I send a quick free email to thousands of readers that shares 3 simple things. 1, my new articles and podcasts. 2, the best financial content of the week from all over the internet. And 3, a financial chart that explains some important concept in the news that week. It's a great primer to boost your financial know-how.
But Jesse, I don't want another email.
Well, this might not be for you, but I do hear you, which is why I make it very short, sweet, and full of only the essentials. A whopping 66% of subscribers read my email at least once a month. They're enjoying it, and maybe you will too. You can subscribe for free on the homepage at bestinterest.blog. Again, that's a free, no strings attached subscription at bestinterest.blog. Okay, and then the last part of this bonus episode, as I alluded to earlier, inspired by Doc G over at the Earn and Invest podcast. I'm going to link to his recent episode that inspired me here in the show notes. Doc G shared what he called an unpopular opinion. And the idea is that in some DIYer circles, mainly in Facebook groups and Reddit subreddits that are dedicated to personal finance and financial independence and retirement planning, probably some groups that you listening right now are a part of, maybe a group where you first heard of this podcast. Some people there are celebrating the financial implications of what's going on right now. I don't want to get into the political aspects of this. I think we all probably know that some people in the US are wildly celebrating tariffs for political reasons. Other people are mourning tariffs for political reasons. And I'm not really a fan of either one of those, something I try to do here. And you guys can let me know if you think I'm any good at it. I might not be. I try my best to leave my politics at the door, knowing that you don't come to me for politics. You come to me for financial planning. So I want to leave politics aside. But what I'm saying is that some people are celebrating our current market upheaval for financial reasons. And that's what I want to address today. They're saying things like, oh, stocks are on sale. It's time to be buying. Back up the truck. Bring on the recession. Could be a generational buying opportunity. Buy the dip. Of course I'm buying. The market always recovers. It always does. Now, in many ways, the people saying these things are readers and listeners and consumers of personal finance content, and they're now regurgitating things they've heard back into other personal finance communities. It literally, it's the echo chamber that we all hear about. That is the echo chamber. I heard something somewhere and now I'm going to regurgitate it. And listen, I know that there are many thousands of you listening to my episodes. So out there, I think it's pretty safe amongst the thousands of you that maybe some of you are excited about the financial opportunities in the future. And I think the excitement isn't merited here. I also think that fear isn't merited here. In fact, I think we'd all do better by leaving our emotions at the door when it comes to portfolio decisions. But specifically, I want to call out excitement. So if you're saying that stocks are on sale, buy the dip, it's time to back up the dump truck full of money and go all in. If you're saying that, you have a flawed investing approach, and we'll come back and I'll explain why that is. If you're cheering for a recession as a means of decreasing stock prices so that you can buy in at lower prices, you're cutting off your nose to spite your face, and I'll come back and explain why. And then last, if you believe that the market always recovers, that stocks always go up, and that the risk of investing essentially is imaginary, then we need to revisit market history together. We need to discuss risk together, and we'll come back and explain why. Okay, let's start with buying the dip. The whole idea of buying the dip, right, is that someone somewhere has this cash hoard, this cash sitting on the sidelines, waiting for the market to do what it's been doing over the past few days. And now that the market is 15% off its highs, they are going to buy the dip. Doesn't make sense. Not a smart thing to do. First off, holding cash on the sidelines, waiting for a dip, means you're losing money to cash drag. In general, the market goes up and to the right. And if you have money sitting on the sidelines, not doing anything, not growing in any way, well, you're going to miss out on potential gains. While you're waiting for the market to crash, you're more likely to miss out on larger gains. Backtest after backtest shows that if you consistently try to buy the dip, if you consistently have money sitting on the sidelines waiting for that dip to come, you are going to lose out. Whereas if you had just invested the money in the first place, simple dollar cost averaging, you would have done better. So right away, buying the dip doesn't make sense. Now, some people have a counter argument to that. They say, well, Jesse, I don't have extra money sitting on the sideline. What I have is my emergency fund, which should be there anyway and is a smart part of a financial plan. I agree with that. They say, I'm going to borrow from my emergency fund in order to buy this dip right now. Well, that's illogical. That puts the rest of your financial plan in jeopardy. If you have a $30,000 emergency fund and you convince yourself that you can take $15,000 of it and buy the dip, just have a $15,000 emergency fund. That bottom number that you choose, eventually you're going to say like, whoa, there's no way I'd let my emergency fund go lower than $15,000. That is you telling yourself that you only have a $15,000 emergency fund, right? You should have had 30 in the first place. So anyway, there's a real logical problem with that argument. And then some people even have a counter argument to that. And they say, well, Jesse, no, I'm going to keep my emergency fund as is. What I'm going to do is I'm going to skimp and save for a few weeks. I'm going to slash my dining out budget and I'm going to cancel Netflix. And then I'm going to use those savings to buy the dip. I mean, like technically, I think from a financial planning point, that's okay. It's just incredibly logically inconsistent because, okay, as of right now, the S&P 500 is where it was about 11 months ago. The S&P 500, we're at the same level now as we were in May of 2024. But at that point, in May of 2024, we were on the way up. We were up about 50% over those previous 18 months. So if you believe that today's stock price is attractive enough to skimp and save in order to buy stocks, then you should have been doing the same thing at the same price level 11 months ago. But nobody was doing that, right? It's pure anchoring bias. Nobody was doing it then because at that point, today's stock level, as of May of 2024, was all-time highs, was 50% up over the past 18 months. Now that we're down compared to a recent high, we're anchored to that recent high. We let that one recent number in our head, that recent stock market high, we let it cloud our judgment. It's the same thing as Amazon raising its prices right before Black Friday to then offer you 30% off. It's smoke and mirrors. It's anchoring bias. It's totally illogical. So anyway, buying the dip, no matter how you define it, is a losing proposition or a completely illogical one. Cheering for a recession in order to get lower stock prices is kind of like toasting your own marshmallow on the fire that's engulfing your neighbor's house. First off, I think about the fact that there are many people listening right now, enough people such that I can confidently say that in a recession, on the whole, it will harm those of us here more than it will help us, right? If I took the average effect of a recession over my entire listener base, we are going to be harmed more than helped. Enough of you will lose jobs or lose customers, your income will decrease, your savings rates will decrease, You might even have to tap into accounts you wish you didn't have to. Your investment accounts will decrease in value too. You won't have free, easy cash to then invest with. But yes, some of you will be financially fine during a recession. You might even actually flourish during a recession, right? That's the way averages work. Some people do poorly, some people do well. And some of you will be able to invest in assets like stocks at lower prices. If that's true for you, good for you. But that's not a reason to get excited, right? Excitement isn't an emotion that benefits us as investors. It's a couple steps away from exuberance and mania, which we know are downright dangerous as investors. And I just think it's best off to leave our emotions at the door before we go off and we make portfolio decisions. I don't know if you've seen The Big Short, but there's that one scene where Brad Pitt's character says, for every 1% increase in unemployment, 40,000 people die. Now that stat is a bit off perhaps, but it's definitely grounded in truth. There are many intro economics books that cite similar data. And there's just not really a reason, I think, to cheer for recessions. If it ends up working out for you, stay calm. Certainly be grateful that it's working out for you and continue making smart personal finance decisions, which might mean investing at lower prices. But again, excitement, first off, I just don't think it does you any favors as an investor. And also, I think there's that it's kind of like toasting your own marshmallow on your neighbor's house as it burns. And then last, perhaps my favorite one here, and maybe the one that is most controversial because it's an opinion that I have that I think is not in agreement. I think a lot of people in the personal finance community disagree with my statement here, but I'll see if I can convince you guys. To those people who think that the market always recovers, well, it's always recovered so far in history, but there's no iron rule of nature that says the market must always recover. There's no iron rule that prevents us as a society from enacting policies that harm our own economy or that harm our markets, that create negative issues from which we might require decades and decades to fully recover from. It's not an iron rule of nature. Something I hear other financial planners saying, and perhaps something I've been guilty of saying before, maybe. I know at one point I wrote an article that involved asteroid impact. I don't remember exactly what I said in that article, but the thing that you hear people saying is they say, well, if the market goes to zero, we have bigger issues to be concerned about. And yes, I do agree with that, right? If the stock market went literally to zero, we would have a bigger issue to worry about than our retirement and our portfolio. But what if the market doesn't go to zero, but simply enters some long period of malaise? Not the end times. There's still going to be food in the grocery stores. There's still going to be gas at the pumps, but maybe we'll all have a lot less extra income to buy iPhones or to buy NFL tickets or to buy trips to Antigua. It's possible. It's possible that corporate America makes less profit than they're making right now. That's a possibility, and it's possible that it could stay that way for a while. There's no iron rule saying that that's not possible, but that's the risk that we take on as stock owners. And I think it's misleading to suggest that because stocks have always recovered in the past, that they must also always recover in the future. It's possible that they don't. Now, is it probable that they don't? No. I think it's probable that they do recover, that this too shall pass, that equity ownership will play out to be a smart decision when we viewed over a long timeline. But it's possible I'm wrong. And if you haven't internalized that truth, I think you ought to. Now, in 2021, I wrote an article about someone had told me that it was impossible to lose in the stock market. And I wrote an article saying, actually, it is possible. And one of my readers said, Jesse, you need to read this quote from J.L. Collins. If you don't know J.L. Collins, he's one of the most well-known financial independence authors out there. He wrote a very good and well-known and well-read book called The Simple Path to Wealth. And in that book, J.L. writes, the market always recovers. Always. And if someday it really doesn't, no investment will be safe and none of this financial stuff will matter anyway. Sounds kind of familiar. Well, everyone, I think, needs to take a deep breath because that statement above, made by J.L. Collins, echoed by countless others, in my opinion, it's a self-defeating prophecy. The more people who believe it, the more true they want it to be, the more dollars wagered on that idea being true, the less likely the statement will hold water in the long run. Now, why is that? Well, let's start with one of Burton Malkiel's famous quotes from the book A Random Walk Down Wall Street. Burton Malkiel wrote, if we knew that a stock would go up tomorrow, why, it would just go up today. He describes the notion of pricing in the future value of an asset into its current price. The more confident we are about the future, the more accurately today's price will reflect that presumed future. Again, the more confident we are about the future, the more accurately today's price will reflect that presumed future. Because, well, if we're confident about the future, it means that we're perceiving less risk. And that means the closer today's price will resemble the future price. And when today's price resembles tomorrow's price, that's another way of saying, well, there's less gain to be had here. So again, that should all make sense, right? The less risk an investment has, the less gain there is to be had. Now, if we apply that idea to market recoveries, we have to ask ourselves, so the more confident we are that markets always recover, the more likely today's price will already account for that presumed recovery. Does that make sense? No, how does that actually play out? How does the market already account for that presumed recovery? This is, I think, maybe a little bit pretzel circular logic-y. Now, if market recovery was a rule of nature, if it had to be that way, if the markets always recovered as an iron law of nature, then recovery would always be priced in. Stocks would never drop in the first place. And if a stock never drops in the first place, right, because it's always going to recover, why would it drop if it always recovers? Well, then stocks are guaranteed to only increase. And if stocks only increase, then there's no risk involved. It's only going up, right? There's no risk. And if there's no risk, then there should be no real return above the risk-free rate. And if there's no return above the risk-free rate, then what's the point of investing in stocks in the first place? That's kind of circular logic, maybe circular in the way that M.C. Escher's famous waterfall is circular. We end up where we started, but the whole world kind of turns upside down. But the more people who believe that the market will always recover, the more likely that claim will be rendered false in actuality. Instead, we need to realize that the risk of permanent loss is one of the driving factors behind stock returns. If stock returns were guaranteed like a treasury bond, then they wouldn't outperform treasury bonds over long periods of time. They would have the same investment return. So the more guaranteed an investment return, the lower that return must be. So I don't begrudge J.L. Collins for his statement at all because it is a paradox. People doubting that markets will recover is synonymous with saying markets are risky. And if stocks are deemed risky, well, investors will demand higher rewards. And over time, any diversified stock portfolio would see high enough returns to hopefully recover from any correction. And so far, that's played out repeatedly as we've seen throughout stock history. This is why markets have always recovered in the past. They only recover because of the risk that they might not recover. Sounds kind of crazy, but it's true. Markets have recovered. They've gone up over time. We've seen gains over time, gains above the risk-free rate, only because there is a risk premium there in stocks. There is a risk. We get rewarded for the risk that stocks might not recover. But as soon as faith in those recoveries becomes too universal, well, the market wouldn't drop in the first place. After all, who would ever sell their stocks to drive down a price if they knew that recovery was guaranteed? Does that make sense? Who would sell their stocks? And selling stocks is what drives down a price. Who would sell their stocks if they knew that a recovery was guaranteed? It doesn't make sense. No one sells if they know the price isn't going to fall. But if there's no fall, then there's no recovery. So yes, it's pretzel logic. It's a bit of a self-defeating prophecy, but it's a fun, maybe small, nuanced idea that ought to intrigue anyone who thinks that markets are guaranteed to recover. There's not. There's risk involved. So this doesn't mean we avoid stocks in the first place. Far from it. It just means that we allocate our capital appropriately to stocks or potentially to other less risky assets based on the timelines in our portfolio, based on our risk tolerance, based on the understanding that certain assets might need a long time to recover if they're going to recover at all. And so if you don't have a financial plan, you probably need one. If you don't know why you're investing, you should fix that. If you don't know why you own what you own, you should fix that. Feel free to reach out to me. Let's start a conversation. I hope we're all getting through some of this tariff mess in one piece. We'll get back to our regularly scheduled blog and podcast publication starting now. So thank you all for listening to this bonus episode about tariffs.
Thanks for tuning in to this episode of Personal Finance for Long-Term Investors. If you have a question for Jesse to answer on a future episode, send him an email over at his blog, The Best Interest. His email address is jesse@bestinterest.blog. Again, that's jesse@bestinterest.blog. Did you enjoy the show? Subscribe, rate, and review the podcast wherever you listen. This helps others find the show and invest in knowledge themselves. And we really appreciate it. We'll catch you on the next episode of Personal Finance for Long-Term Investors. Personal Finance for Long-Term Investors is a personal podcast meant for education and entertainment. It should not be taken as financial advice, and it's not prescriptive of your financial situation.